So, hello, and a massive hello to everybody. Hope we're all having a great day wherever you are, whatever you may be doing. This is 50 pips, rocking and rolling. 2nd of June, 2019. No trade calls, recommendations, or response for their own stuff. We're here for educational purpose only. So, welcome to June Trade. Guys, a lot of things to discuss here. So, let me try and tackle these one by one. So, first of all, we have to be on deck because still a lot of headline risk out of Brexit, out of the EU, out of Italy, out of Mexico, out of China, out of the US. So nothing changes there, okay? In terms of the data front, we're going to have a lot of data out of China. We've got all the PMIs coming out this week. We've got an RBA rate statement and GDP, so a lot of data out of Australia. We're going to have Powell speaking, Karuta speaking, and Carney speaking. We've got an ECB rate decision, so with press conference, and we're going to have non-farm payroll. So the data calendar is stacked, full data calendar, and full headline risk possibility, right? Now, one thing which I would also just go through quickly is a lot of people wrote in asking me, what should we look at, or should we look at anything specific in terms of seasonals going into June? Well, I think in terms, if you're looking at the energy complex, you tend to see a bullish June for the energy complex. So for natural gas, for heating oil, and for crude, right? And then this is actually when after June, we tend to go towards the heavier part of the year, right? Especially for crude, seasonals are bullish the first 6 months of the year, and then they start to, we start to head down. So that's the classical thing you would be looking at in terms of the energy complex. In terms of the financials, I mean, there's nothing super duper interesting in terms of the financials. But one thing which you'd want to keep in mind is that basically in terms of equities, June tends to be one of the 3 worst months for the equity market. But what we've seen recently is that a lot of the seasonals are kind of being inverted. So you have to take those with a little bit of a pinch of salt, right? So I wouldn't necessarily be focusing too much. There's nothing super that really super sticks out in terms of the seasonals. I mean, we prefer to look at it when the seasonals come in, when you've got the start of a kind of a 3-4 month seasonally bullish pattern or bearish, not when it's just necessarily a one-off here or there. But again, let's see. Also, metals are not too big. Tends to be a little bit heavy for the metals, but again, nothing that we would really go to, focus too much on, except for gold and silver aren't really bullish. I think here the focus is, as we're going into this this week, what is the focus? Well, a lot of people will be talking about something which we have been highlighting for weeks, right? And what we were saying is, heads up, as this is starting to turn heavy at the 10-month moving average on the indexes, right? And we look at the SPY, or you can look at the ES, because essentially in terms of market timing models, a lot of people will be looking, when they're weighting their portfolios or breaking those out, at the 10-month moving average as a trigger. So a month close below the 200 moving average is bearish. So a lot of the market timing models will either go flat equities into cash, or they'll go short equities, right? So this is something to keep in mind. Now, I wouldn't go gung-ho about this stat, but what I'd keep in mind is that when you see this kind of heavy close on a monthly, right, and we close right on the lows on the month, and it also comes in line with a break below the 10-month moving average, what you have to keep in mind is that even if you think there is a squeeze coming, there is zero edge in trading this with a tight stop below previous month lows, because it's extremely rare that we do not print lower. Okay, so your base case expectation going into the new month this week is that this is not the low print. even if this is going to be a cycle low for all new time highs, this is not going to be the low print. There'll be a lower print, okay? So that's the first thing I would keep in mind. The other thing I would focus on before looking at these charts is that, as far as I'm concerned, the quickest bang for your buck, or the most the thing that looks the most overdone here to me, is the bond market, right? So whether you're looking at ZBs or ZNs, the move we've seen here is very, very aggressive, okay? You could see here off these lows, this is exactly where we expected the ZBs to bounce, and this was a very choppy zone. And we said, this is still holding a multi-year cycle trend line. And so it's no surprise to see a bounce. But what is, I think, notable is the speed at which we've had this whole bounce. Now, especially this last part. So what you have to keep in mind is that here we've gone really aggressively back here without pulling back at all. Basically, the market is really pricing in this Fed starting to cut like there's no tomorrow. We'll have to see in a couple of weeks. But also, as we're approaching the 50 back of this move down, I think the quickest bang for your buck, or the most interesting thing to look for going into this week and going into the Fed, is shorts on something like the ZBs or something like ZNs. Also, these are monthly charts. Now you see here what's happening on the ZN. Again, we've had this move down. We've come back into the 50, 61%, and you're coming here on the 50 and on the 100-month moving average. So what are the chances that, unless something horrible happens, you would not expect this to go knife through butter? And again, the market is really extended here. So I think if you like to fade, if you like to look at key inflection points, you have to keep this on the radar. Also, when we're in a weekend where I've been seeing on Twitter, everybody spent the weekend already. On Saturday, people were quoting CFDs, weekend prices for the indices and stuff. Everybody's expecting us to open and crash now on Monday or on Sunday. Usually when everybody expects this to happen, it's so telegraphed that it rarely happens. So again, I would be more partial going into this week to look at any bounce on ZBs or ZNs as a shorting opportunity, and any dip on gap down on the equities as a buying opportunity, rather than the other way around. Okay. Now let's look at some of these charts in a little bit more detail in the weekly. We've got a lot of moves in play, so we'll have to go through these now. On the weekly, on the Swiss franc, we were looking this to come right back down into this ascending trend line. So this trade is in play. And also, because when we close so heavy, you would not expect this to be a low, we fully expect to see these lows print. We fully expect to see it back into that descending trend line, right? So maybe, I beg your pardon, I should start with the DXY in general. The DXY, and we've talked about this a lot, we would not be surprised if we continue to chop around for a long time inside the 98 and the 96. It seems that everybody gets excited every time we poke our head above the 98, but you can look at something even on the 1 hour, you see that we can't hold these breaks. Now, I'm not going to go through all the discussion we've had before why we think we still be fading the 98, but this is really the chart, right? You see what's happening. We keep on failing there. So the big question is, are all these failures for us to rally to new highs on the dollar from a lower level? Or is this going to completely puke? Or are we just staying inside this range? Our base case is that this move is a little bit overdone, and that we will not see an aggressive break through that 98. We're more partial to longer picture, expecting this to stay inside the 98, 96 range. However, what happens from a longer term perspective, we don't know, and nobody has a crystal ball. But our base case here is that this is going to top, and we're going to come to at least a little bit more neutral, so you can call it back towards that 97. Okay, so taking that back to what we're looking at, that means that dollar weakness, it means we get a chance to for this Swissy to complete back here. Clearly, this is not an area where you'd want to get aggressively short, but we are more than comfortable trying to ride those shorts. And what we'll see this week and going into the Fed is that if that dollar kind of stabilizes around that 97, it'll probably mean that this area with all this confidence of moving averages will hold. If not, it's going to puke, but we would not be surprised to see it come right back here. Now, you could argue that this is some kind of wedge action here, and when the wedges break like this, what you expect is to see them retrace the whole move. So that would be a final target on a break below those moving averages. But unless we see a move below those moving averages, we can't use that as a base case assumption. But if we get a daily close below this last moving average, extremely high conviction that we're going to go and retrace this whole move higher. So this is completely in line. In terms of our Euro GPB swing longs, this is complete for now into these mid, unless you're looking for that bigger move. But the percentage play for us is done here, and we don't really think there's a lot of edge doing anything here at mid-range. EJ, not a lot to do, I would say. Aussie, we're looking at this to try and base here. And again, if you start to see, especially this dollar pulling off a little bit, and should we see a squeeze on equities, we'll look at equities at the end. So a little bit of risk on coming back into the market. Again, we have to be careful because we've got the RBA and GDP data out of Australia this week. But our base case assumption is still that if this 68.50 holds from a day close perspective, the path of least resistance is to come back into these moving averages right here. This trade we discussed on those weekly updates, and this trade is in play, no change. Similar on Kiwi. You've got a lot of different plays, but on Kiwi, as long as this level holds, this support holds from a day close perspective, our base case is that we're coming right back into those moving averages, right back into those 69.50s. This trade is in play, no change in outlook here, still trying to hold. When we're looking at CAD, we don't have an open trade here, but it's trying to play what we've been looking at, which is this completion of another round of symmetry, basically 1, 2, 3, 4, 5. And basically you see how we've peaked at these symmetrical patterns. And here, especially if crude keeps on puking, right? And if equities trade a little bit heavier, well, then this is the path of least resistance. Again, I would not be surprised to see this happen before we finally go back up there. But, you know, we'll have to wait and see. Bottom line, this is not cheap enough to buy and not expensive enough to sell, really. In terms of cable, we have no open trades here. We expected this to try and base at one of these round numbers, and it is trying to hold the 126. I think that here, if anything, you'd play for a squeeze back into this higher level, not for a puke here unless you're still holding short. I think there are far more interesting trade ideas than to try be involved in cable here. If you're looking at Euro, our base case is still that, and we'll have to see what Draghi does. But if we don't get a day close below the 111, we still think the path of least resistance is a squeeze back into the 114, possibly higher. Now, you have to keep in mind, with all the negative news flow coming out of Europe and the data, which has been far from awesome, right? This has been holding remarkably well. Now, you can argue it's because of a lot of deleveraging of risk on flows, and a lot of people that have funded EM trades with Euro are flattening those up, so they have to buy back Euro, and that's what's holding it. But keep in mind here, I mean, if you start to get some kind of data out of Europe, which is not as horrible as it's been so far, or if Draghi is not as dovish as everybody expects, there's a big squeeze that could come into play here. So I think the chart is heavy, the pair looks heavy, but if you're looking at possible velocity of move or asymmetry, you know, any longs here, as long as this holds for a squeeze back to the 114, clearly the risk reward is in favor of the longs, not the shorts. Yen, one of our favorite trades. This continues to trade. We're still looking for this to come back all the way down into these lows and potentially back into the 100. And this is still in play. This is also completing quite a nice fib move, A to B, remember, came back into the confluence of the moving averages C, and the 123 extension is coming in here at the 108.20s. And so we'd expect this to be done at the open overnight. Then if we break through the 108, this could accelerate if equities puke hard into extension into the 107.30s, 106.90s. If not here, what you would expect to see is a puke back down into, that 123 extension or into the 108. If the 108 holds, then that kind of retracement for one of these two levels to then continue lower from there, right? This is not the kind of open where you want to press the current move, okay? Now, gold and silver are still kind of stuck. Silver is not really moving, but if anything, this is still a base zone, not an area where you'd want to get short. And a lot of people are saying now, is gold going off to the races? Now, remember, our base case here, as we're discussing also for those of you that are in the weekly webinar, is that gold is currently stuck inside 1250, 1300, and 1350. And you see how it's tried to base all ahead of these moving averages in that 1250. So here, the way I'd look at this is, unless the equities completely puke, you would not expect this to break above the 1350. I think here the only way where you can say, okay, gold is off to the races and it's going to explode is we have to see, equities open Sunday, Monday, and down 5 to 10%, and things have to cascade and get very ugly. If not, like we looked at yen, like some of the other pairs, chances are this is going to break a little bit higher and then retrace back into a little bit more neutral territory, which is going to stay around this 1300, and then see what the rest of the market decides to do. Crude, this is playing out beautifully. If you remember, our trade here was the short on the weekly close, stop above those highs, looking for a move back into the 200 DMA and the 55 mark. Now here, this is an example of how people who are very mechanical often get beautiful moves. Like here, I didn't trade this, I didn't stick on this move because I simply did not want to get caught with a headline overnight or over the weekends. We had all those headlines out of Middle East, out of Iran, etc. The last thing I want to do is be caught in one of those over the weekend and you got crude gapping up 10 bucks. It's just an impossible trade to hold. But this is an example of somebody who's just back testing and looking at stuff, with a rear view mirror without factoring in context. It has got no problem. This is as easy as they come, right? This is a pure little trade. The problem here is that if you're trading real and you have to hold this trade over the weekend, you don't do it, right? Because you don't want to get caught with unless you're trading very, very small, you don't want to get caught with a silly gap up over the weekend. But here, in the same way, gold is getting a bit extended to the upside. In the same way, bonds have gone completely crazy. I mean, it doesn't mean that this can't go straight line puke, but if anything, if this is going to bounce somewhere, this is where you'd expect it to bounce. You'd expect it to open, gap down a little bit, take out weak players below this 200, and then try and bounce a little bit. So I definitely would not be trying to get short in the hole here on crude, right? And if you're looking at the equities, you have a similar kind of scenario, right, where markets have traded very, very heavy. You see how the week closed very, very heavy. We closed below the 50 DMA, which is very, very heavy, below that pivotal 2775, where we expect to see a lot of deleveraging, both from CTAs, both from market timing models, etc. And if you look at it on the daily, it's closed below that 200. Now the question is, do you sell it here into the hole? No, right? Look at this move here, A to B, similar to yen, right? So what's happened here? We've gone right back down, we retraced the 50, and now we've gone through the 123 extension. So has this got more room to come? Maybe, but if anything back here into the 2720s tonight, or 2720s to 2700. To me, this is going to be a bounce opportunity, a buying opportunity, right? Especially if you start to get some constructive headlines out of China, some constructive headlines out of Mexico, right? You expect to see this bounce right back up here, possibly even higher. Now, keeping that kind of theory in mind, what are the chances as we're going, getting heavier and heavier? Is Trump and everybody, are they going to continue to pile in on the negative headlines, or are they going to try and put out some nice headlines to try and cause a little bit of a bounce, right? I think that I wouldn't be surprised if Trump and co did it on purpose to let a little bit of air out of the market, but sooner or later they'll be pumping it again, so you can't really chase this, okay? Now, remember, ES broke below that 2775. YM has been the heaviest. It's broken below that 25,000. So things are heavy, but I would be careful trying to chase them at the lows. It's a similar discussion with, if you look at something like the NASDAQ here. So you see what happened. A lot of people will be posting these kind of charts probably. You see these wedges here. When you see these breaks of these wedges, what the technicals say is that usually you get a full retracement all the way to the bottom of the wedge. So here, all the bears are going to be extremely excited here on NASDAQ because they're said, that's it, we've broken down here, and we're going to come right back down and retest the low of the wedge, which we're completely in line with. If you remember, we've been talking about, we think that these lows are going to be retested, right? The bottom line is just, we don't think that they're going to be retested in a straight line. So I think it makes a lot more sense here or into the 7,000 to play for a bounce and then get short again. But even if we do get there, it's not even gonna be like this, right? You should think about what is a more healthy kind of action. And the healthy kind of action could even be, it could be something very, very messy, right? All the way down. You can't always play for things to move in a straight line, okay? So going back a little bit of a summary into the week on equities, we expect these to find some kind of a base and rally a little bit, especially if the market is getting too bearish and if we start to get some positive headlines, especially as we go with all these with all these central bankers, with Draghi, etc. We would not be surprised to see a massive squeeze. But even if we get a move all the way back into the 50, that's probably going to be a nice sell. I think if you're bear, your wish would be to see this gap down into the 2720s, and you want to see a monster rally that scares the hell out of everybody all the way back, at the very least back into the 2880s, maybe even into the 2900s, and then you get short again, okay? Not short, you don't want it to go down in a straight line. Okay, so that's what I would be saying inside the equities. Are the same thing on the bonds. I'd be looking for any kind of rally to be a sale. I think you'll get a better bang for your buck if these things turn being short bonds rather than being long equities. And in terms of the dollar, we'll have to see how this plays out here, but it looks like we've got a little bit more weakness in the dollar. And my preferred play there is especially if we get this bounce in equities, this move back down in bonds, so a little more of that risk on flow, is the long on Kiwi, right? Or the move on the commodity currencies. Again, keep in mind we've got Draghi and a lot of stuff on deck, a lot of data, but that's pretty much where we are. Now, I'm sorry we're going towards 25 minutes. 10 minutes longer than the usual update, but there's just too much stuff to condense into a 7 or a 10 minute update. Wishing everybody an awesome one. Talk to you guys soon. Take care. Bye-bye.